part number 2, here's the monthly chart. Part number 2, welcome to stockmarketfunding.com. Here is part number 2 of the weekly. And now that our logo is on here, welcome to stockmarketfunding.com, part 2 of the S&P, how to trade put and call options using risk management tools at stockmarketfunding.com. So basically what we've done here, people, is that the 1140 put was up 59%. And the low on Friday on that 1140 put was 562, and the high was 11.45. And that put option made money on Friday because we had an overbought and a sell-off. And part of that was news related. Okay? The other thing that I would like to say is that the other side of the trade, which is the volatility side from part 1, is that 1250 call up and out of the money, right slightly above half of that bar. That was on 9/1 of 2008 when the selling started and capped off the rest of the 2008 down move. And basically it's 10:50 a.m. Pacific Standard Time. And what pro traders that have enrolled in the school is they're going to learn that the put option of that put right here, 1100 put, had a 72% gain on Friday. And basically the way that we're going to trade this is why this is down 54%. We have to buy the call at the lower price. So that when we move up and this goes up and this comes down in the net change in percent is when we'll put the risk management part of the trade on. Now from a weekly perspective, I'm going to draw some trend lines. I said the 1140 and this is a weekly. And I'm going to draw a support line right here and that's 1178. If I break that, I've got the last, what was the January high, which we shorted by the way. That broke above there and 4 weeks we went higher and we put a top in right below that 200 week. And basically on the MACD you're overbought. You're way up here at 39.0. We are going to buy the put option. Basically what we're doing here is if we were to break that support level, which was the swing high reversal in January, is that's the 10-week moving average where the S&P would have support. And basically there is nothing bearish about the fact that we've ran a little bit too far too fast and that reaching the high percent DS level says we're overbought. And we can stay overbought for a period of time. It is possible. That is a distribution bar on the week, number 1. And basically starting next week, if we get a closing bar below the body of the top of the body of this bar, so let me blow the chart up for people on the weekly. If this is a weekly reversal bar, that means I will not close back above 1192 of the high part of this little red bar right here, because I won't. And what would end up happening is that I would have the bottom of the bar be resistance at 1190, and I would not close. So basically if this case happens, that means that would be resistance. That means that this, and you would work lower and you would not go above it. This is a support one at 1180 that could be broke. And if we go down below it and we get down here, if this does happen in our trade management, is that when we get down here, if it gets positive, what we will do is we would look at cashing in the put. We would still hold that volatility trade, okay? And or we could cut one side of the volatility trade, let it come down and buy another volatility trade. There are several ways that we will work this risk management based on this weekly chart here. and that this would be the high with next week heading down. But with the amount of earnings that we have, and that's your peak right there to that intraday high on Friday. So with the kind of earnings we have coming out, it wouldn't be out of the ordinary that taking Friday sell-off off of Goldman News and try to continue popping that run. And that's why we have to have that 1250 call for very cheap, which is right here. It's only going to cost us a little bit of money. However, that 10 contracts that we buy for $2 is $2,000 to protect that move up. And we would make the difference, and we'll end up making a profit when it comes to trading these instruments. But we are overbought. The last overbought cycle that we had in the latter part of 08, that indicator, which my pointer's on right here, was 86%. Okay? And this is on the S&P. The January high, we were at 77%. And basically right here, we're at 90%. This is on a monthly. The more overbought you get on a monthly, yeah, it's strong. Don't get me wrong. But we're volatility traders, and contrary to the fact of understanding that these monthly moving averages right here, just on the monthly, this happens to be a 40-month moving average, and the 50-month moving average is right up here. And that's another reason why we're putting on the $1,250 call as a risk management trade. And that's holding that down as resistance. Over here, the 200 week is slightly about 1222. It's exactly 1224.7 at the 200, and that's upward resistance. Along with the weekly overbought, percent DS went down 1 week, and the overbought here. And this is how we are going to trade, using the volatility call and the lower end of the put, and then we'll see which way the indexes want to go and what the trade management will bring for huge profits. You've been given a gift. Thank you for visiting StockMarketFunding.com.